Seriously, don't even think about buying a house until you watch this. Every single year, thousands of first-time buyers, people just like you, make the same handful of costly mistakes that turn their dream home into a financial nightmare. They fall into hidden traps they never saw coming. They get blindsided by thousands in unexpected fees. They end up trapped in a house that just bleeds them dry month after month. It's a devastating disaster, and it's completely avoidable. But that's not going to be you. As a real estate pro who has guided hundreds of people through this exact process, I've seen every mistake in the book. I made this guide for one reason: to make sure you avoid them. In this video, I'm breaking down the 10 biggest hidden traps in mortgages, inspections, and closing costs. By the end of this, you'll have a complete roadmap. You'll know exactly what to do, what to watch out for, and how to navigate this process with total confidence. Let's get into it. Section 1. Mistake number 1. House hunting before getting pre-approved. All right, let's start with the first, and honestly, the most common and damaging mistake I see buyers make: shopping for a house before having a mortgage pre-approval in hand. I get it. This is the fun part. Scrolling through Zillow at 11 p.m., saving homes, picturing your couch in the living room, imagining where the Christmas tree will go. It feels productive and it's exciting. Talking to a mortgage lender, gathering paperwork, and discussing finances, that feels like work. Most people push that part off. But here's the truth. Looking at homes before getting pre-approved is like walking onto a car lot with no idea what you can actually afford. You might fall in love with something completely outside your range, and now your decisions are emotional instead of strategic. And emotional decisions in real estate almost always cost you money, or at the very least, unnecessary stress. And let's clear up a big misunderstanding here, because a lot of buyers confuse these two terms. A pre-qualification is not the same as a pre-approval. A pre-qualification is usually just a rough estimate based on information you verbally provide. No verification, no deep financial review, just a ballpark number. It feels official, but it really isn't. A true pre-approval is different. That's when a lender actually reviews your financial picture. They pull your credit, verify your income through pay stubs and W-2s, review your bank statements, and confirm that the funds for your down payment are real and accessible. At that point, the lender is essentially saying, yes, based on what we see, we are prepared to lend you this amount. And this matters more than most buyers realize. Without a pre-approval, you don't actually know your budget. You're guessing. Maybe you're browsing homes around $500,000 because that's what feels comfortable. But once the lender calculates your debt-to-income ratio, taxes, insurance, and current interest rates, you might only qualify for $425,000. Now imagine falling in love with a house, picturing your life there, only to find out you were never really in the running. I've seen buyers go from excitement to frustration in a matter of hours. It's avoidable, but only if you start in the right order. There's another big reason this matters: competition. In a competitive market, sellers don't just look at price, they look at certainty. They want the offer that is most likely to close without delays or surprises. An offer without a pre-approval letter tells the seller, this buyer might not even qualify. And when they're comparing offers, that uncertainty usually puts you at the bottom of the pile. If there are two similar offers and one buyer is fully pre-approved, that's the one sellers choose, every single time. The good news? The fix is simple. Before you even start touring homes, talk to a lender. Get your documents ready, typically 2 years of W-2s, about 30 days of pay stubs, and a couple of months of bank statements. The process is usually faster than people expect, and once it's done, everything changes. Now you know your true price range. Now your agent can target the right homes, and when you find the one, you're not scrambling, you're ready. That's when house hunting actually becomes fun, because you're shopping with confidence instead of hope. You're not guessing anymore. You're making moves from a position of strength. And once buyers get past this first mistake, that's when we run into the second big one. And this one can cost you thousands even after you're already under contract. Section 2, mistake number 2, underestimating the true cost of homeownership. The second massive mistake that sinks a lot of first-time buyers is focusing only on the sticker price and the mortgage payment. You get pre-approved, you find a house you love, and you think, okay, the mortgage is $2,500 a month. I can do that. And on paper, that sounds reasonable. But here's the reality. That $2,500 is just the tip of the iceberg. The true cost of owning that home is much bigger, and ignoring that is how people end up house poor, living in a beautiful home but feeling financially stressed every single month. And the problem isn't that people can't afford the home. The problem is that they didn't understand the full picture before they bought it. So let's talk about something every buyer needs to know. PITI. PIT. I stands for principal, interest, taxes, and insurance. And this is what makes up your real mortgage payment. Principal and interest, that's the loan itself. It's the number everyone looks at first because it's the easiest to understand. This is the portion that pays down your loan balance and covers the lender's interest. Taxes, property taxes paid to your local government. These can be significant, and here's something many buyers don't realize. Taxes can increase over time. So even if your loan payment stays fixed, your total monthly payment can still go up. Most lenders collect a portion of this monthly and hold it in an escrow account so they can pay the tax bill when it's due. Insurance, homeowner's insurance. Your lender requires it because they need to protect the property from risks like fire or major damage. Just like taxes, this is typically included in your monthly payment through escrow. But we're still not done. If you put down less than 20%, you'll most likely have private mortgage insurance or PMI. And this is where a lot of buyers get surprised. PMI doesn't protect you. It protects the lender in case you stop making payments. Depending on the loan, this can add hundreds of dollars to your monthly cost until you build enough equity in the home. And if the property is in a condo or a planned community, there's another layer, HOA fees. These might cover landscaping, exterior maintenance, amenities, or common areas, but they can easily add a few $100s a month, sometimes more. And unlike your mortgage, HOA fees can increase. Now let's talk about something that doesn't show up on any mortgage calculator, the cost of simply living in the home. Utilities go up. Heating and cooling a house costs more than an apartment. Water bills, electricity, internet, it all adds up. And then there's maintenance, which is the part most first-time buyers underestimate. When something breaks, there's no landlord to call. The water heater fails, that's on you. The roof leaks, that's on you too. A good rule of thumb is to budget about 1% to 2% of the home's value every year for maintenance. On a $400,000 home, that's roughly $4,000 to $8,000 annually, or about $330 to $670 a month that should realistically be set aside for future repairs. And this is where buyers either feel comfortable in their home or constantly stressed by it. The solution isn't to avoid buying, it's to plan properly. Go beyond the online mortgage calculator, build a real-world budget, open a spreadsheet and list everything: your full PITI payment, PMI if applicable, HOA fees, estimated utilities, and a maintenance reserve. When you look at that total number, that's your real monthly cost of ownership. This isn't about scaring you away from buying a home, it's about preparing you so you can actually enjoy it. Because the goal isn't just to own a home, it's to own it comfortably, without feeling like the house owns you. And once buyers understand the true cost of ownership, that leads directly into the next mistake, one that can quietly cost you thousands before you even realize it's happening. Section 3, mistake number 3, not shopping for your mortgage. All right, mistake number 3 can quietly cost you tens of thousands of dollars, and the crazy part is how easy it is to avoid not shopping around for your mortgage. A lot of buyers make this mistake without even realizing it. They talk to one lender, usually the big bank where they already have a checking account, get a rate, and assume that's just what mortgages cost. They accept it and move on. But that's like walking into a store, seeing the first price tag, and paying it without checking anywhere else. You would never do that when buying a car or booking a flight, yet people do it all the time with the largest loan of their lives. Here's what you need to understand. A mortgage is not a one-size-fits-all product. The interest rate, lender fees, closing costs, and even loan terms can vary significantly from one lender to another, even for the exact same buyer with the exact same credit score and income. Every lender prices risk differently, has different overhead, and offers different programs. And the difference might look small at first. Maybe it's just 0.25%. That sounds minor, right? But on a 30-year loan, that small difference becomes massive. On a $400,000 loan, a 0.25% difference in interest rate can mean nearly $50,000 in additional interest over the life of the loan. That's not pocket change. That's a car. That's a major renovation. That's a huge portion of a college fund gone simply because you didn't compare options. So who should you actually talk to? You've got a few main options. Big banks. These are the household names everyone recognizes. They can be convenient, especially if you already bank there, but convenience doesn't always equal competitiveness when it comes to rates and fees. Credit unions, because they're member-focused and nonprofit, they often offer very competitive rates, lower fees, and a more personal lending experience. Mortgage brokers. Think of a broker as a personal shopper for your mortgage. Instead of offering just one product, they shop your loan across multiple lenders to find the best fit for your specific situation. Now, here's the strategy most buyers don't know. You want to apply with at least 3 lenders and ideally on the same day. For example, a bank, a credit union, and a mortgage broker. Timing matters because credit bureaus treat multiple mortgage inquiries within a short window as a single event, so you can compare options without repeatedly hurting your credit score. Within 3 business days, each lender is required to give you something called a loan estimate. This is a standardized document, which means every lender presents the numbers in the same format. That makes it incredibly easy to compare offers side by side. And don't just look at the interest rate. Look at lender fees, closing costs, and the total cost of the loan over time. Sometimes a lender advertises a lower rate but makes up for it with higher fees, wiping out any real savings. And here's something experienced buyers learn quickly. Numbers matter, but service matters too. A loan officer who answers calls, communicates clearly, and solves problems quickly can make the difference between closing on time or losing a deal altogether. When you're under contract and deadlines are tight, responsiveness becomes priceless. The key takeaway is simple: make lenders compete for your business. That competition is what gets you the best deal. And once buyers secure the right loan, that's when we run into the next mistake. One that doesn't show up until after you find the perfect home, and it can completely derail a deal at the last minute if you're not careful. Section 4, mistake number 4, choosing the wrong real estate agent. This next mistake is one people don't even realize they're making until it's way too late. Choosing the wrong real estate agent. A lot of buyers underestimate how critical this decision is. Some think they'll save money by not using an agent at all. Others feel obligated to work with a friend, a cousin, or someone who just got their license and needs the business. Both of those decisions can cost you big time. Let's clear up the biggest myth right away. As a buyer, your agent is typically paid through the transaction by the seller. The commission is negotiated in the listing agreement and split between the listing agent and the buyer's agent. So in most traditional transactions, you're getting professional representation without writing a separate check for it. Trying to navigate this process alone to save money is like trying to represent yourself in court because you watched a few YouTube videos. Real estate contracts are legally binding documents. Deadlines are strict. Negotiations are strategic. You don't know what you don't know, and that's where mistakes get expensive. And here's something important. Not all agents are the same. A great buyer's agent does far more than unlock doors and schedule showings. That's the bare minimum. A strong agent is your strategist. They analyze comparable sales to make sure you're not overpaying. They understand market trends and can tell you whether a home is priced aggressively, fairly, or optimistically. They are your negotiator. When it's time to make an offer, they structure it in a way that protects you but still makes it attractive to the seller. They know when to push, when to hold firm, and when to walk away. They are your project manager. Once you're under contract, there are inspections, appraisal deadlines, financing contingencies, title work, walkthroughs, and each one has timelines attached. Miss one, and you could lose your deposit or even the deal. Now let's talk about what happens with the wrong agent. An inexperienced or part-time agent might not understand how to compete in multiple offer situations. They might underprice your offer strategy or fail to highlight your strengths as a buyer. A weak negotiator can easily leave thousands of dollars on the table during inspection negotiations. An agent who isn't organized can miss deadlines that put your earnest money at risk. And sellers pay attention to who represents you. I once saw a seller receive 2 offers. The first was from an experienced agent. Clean paperwork, organized contract, strong lender letter, clear communication. The second offer was actually for slightly more money, but it came from an agent who submitted incomplete paperwork and missed key details. The seller chose the first offer, even though it was for less money. Why? Because the first agent projected competence and certainty. The seller trusted that deal would close smoothly. The second buyer lost their dream home not because of price, but because their agent looked sloppy. That's how powerful representation is. So what's the solution? Interview at least 3 agents before committing. This is a job interview. You are hiring someone to guide you through one of the biggest financial decisions of your life. Ask real questions. How many buyers did you successfully close with last year? How many of them were first-time buyers? What's your strategy in competitive markets? How do you help clients win in multiple offer situations? How do you communicate and how often? Can I speak to a couple of your recent clients? Pay attention to how they answer. Are they confident, clear, data-driven, or vague and overly casual? You want a full-time professional who knows your target neighborhoods inside and out. Someone who understands pricing, contracts, and negotiation psychology. And just as importantly, someone who communicates well and makes you feel informed, not confused. Because at the end of the day, this isn't just about buying a house. It's about protecting your money, your time, and your future. And once you've got the right agent in your corner, there's still one more mistake that can quietly sabotage buyers, even after they've done everything right up to this point. Section 5, mistake number 5, making emotional rush decisions. The home buying process is emotional. You're not just buying drywall and a roof, you're buying a future. And because of that, buyers are wide open to mistake number 5, making rushed, emotional decisions. This happens in a couple of ways. First, you get house fever. You're tired of looking, you just want it to be over, and you find a house that's good enough. So you convince yourself it's perfect, ignoring some pretty big red flags just to be done with the search. The other scenario is getting swept up in a bidding war. The fear of missing out, FOMO, is real. Your agent calls and says you need to offer $20,000 more and waive the inspection. Your heart is pounding. You don't want to lose this house, so you agree, throwing your budget out the window and gambling away your most important protection. This is how buyers wake up a month later with a mortgage they can't afford and a $15,000 foundation problem the inspector would have found. Making a good decision requires a clear head. You can't let the heat of the moment drive the biggest financial choice you've ever made. The solution is twofold: preparation and patience. First, before you even start looking, create a needs versus wants list. Be brutally honest. Needs are your non-negotiables. Number of bedrooms, a specific school district, a max commute time. These are deal breakers. Wants are the nice-to-haves, a 2-car garage, a big backyard, hardwood floors. When you're emotionally wrapped up in a house, this list is your anchor. Does this house meet all our needs? Or are we just being seduced by the wants? It cuts through the noise. Second, commit to your budget. Your pre-approval is a ceiling, not a target. Decide on a maximum purchase price you're truly comfortable with and write it down. When a bidding war starts, that number is your hard stop. The house you can actually afford is always better than the dream house that makes you house poor. And never be afraid to sleep on a big decision. Walking away from a bad deal isn't a loss, it's a victory. If you're finding this valuable and feeling a little more confident, do me a quick favor and hit that like button. And make sure you subscribe so you don't miss the second half of this guide. We're about to get into the single most expensive mistake you can possibly make. Section 6, mistake number 6, skipping or skimming the home inspection. We've arrived at the single most catastrophic mistake a home buyer can make: skipping the home inspection. In a hot market, some buyers waive the inspection to make their offer look better. Let me be blunt, this is financial insanity. It's like buying a used car for $400,000 without ever popping the hood. A home inspection costs a few $100, but it can save you tens of thousands in surprise repairs. An inspector's job is to examine the property's major systems and find any big defects or safety hazards. Those cute listing photos don't show you the foundation crack behind the bushes, the outdated electrical panel that's a fire hazard, or the slow leak under the sink that has created a huge mold problem. The inspection is where the truth comes out. A good inspector focuses on the 4 cornerstones of the house, the big ticket items that cost a fortune to fix: the roof and attic. They'll check the shingles, the flashing, and look in the attic for signs of leaks or bad ventilation. A new roof can easily cost $10,000 to $30,000. You don't want that surprise. The foundation and structure. They'll look for major cracks, signs of water damage, and other clues that the house's backbone is in trouble. Foundation issues are a financial nightmare. The plumbing system. They'll check for leaks, test water pressure, and identify the type of pipes in the home. Some old pipes can be a huge red flag for insurance companies. The electrical and HVAC systems. They'll check the electrical panel for safety hazards and run the heat and AC to make sure they work. A new HVAC system is another $8,000 to $15,000 expense you want to know about ahead of time. The solution is not just to get an inspection, but to go to the inspection. Follow the inspector around, ask questions. This is your chance to really learn about the house. The final report will be your to-do list and your negotiation tool. If big issues pop up, you can ask the seller to fix them, give you a credit, or lower the price. And if the problems are just too big, your inspection contingency is your golden ticket to walk away from the deal and get your deposit back. Never ever give up that right. Section 7, mistake number 7. ignoring the seller's disclosure. Before your inspection, you'll get a document called the seller's property disclosure. Mistake number 7 is either ignoring this form or treating it like it's 100% gospel. You have to find the middle ground. This is a legal form where sellers have to list any known problems with the property, a past roof leak, a flooded basement, that kind of thing. Here's the trap. Some buyers see the seller checked no to all the problems and just assume the house is perfect. Big mistake. A seller can only disclose what they know. If they have no idea there's a slow leak inside a wall, they can't disclose it. And let's be honest, some sellers might conveniently forget about a problem. That disclosure is not a warranty. It's just the seller's statement of what they're aware of. On the other hand, don't get spooked by a long disclosure and run from a great house. An honest seller who tells you they had a roof leak professionally fixed in 2018 is actually being transparent. That's a better sign than a seller who claims their 30-year-old house has never had a single problem. The solution is to use the disclosure as a roadmap for your investigation. If they disclose a past basement flood, ask follow-up questions. When did it happen? What was the cause? Who fixed it? Can I see the receipts for the repair? Give the disclosure to your home inspector and tell them to pay extra attention to any issues the seller mentioned. Think of the disclosure as the start of a conversation, not the final word. It's a clue that helps you and your inspector uncover the full story of the property before it becomes your problem. Section 8, mistake number 8, forgetting about closing costs. You've navigated the offer and the inspection. You're in the home stretch. Then, a few days before you get the keys, you get a document and your jaw hits the floor. It's a bill for thousands, even tens of thousands of dollars you had no idea was coming. This is mistake number 8, forgetting to budget for closing costs. Most first-time buyers focus all their savings on the down payment, but that's not the only cash you need. Closing costs are all the fees you pay to finalize the loan and transfer ownership. These costs are separate from your down payment and usually range from 2% to 5% of the home's purchase price. So on a $400,000 home, be ready to pay between $8,000 and $20,000 in closing costs. This is a massive expense that blindsides way too many people. So what are you even paying for? It breaks down into a few categories. Lender fees. This is what your lender charges to create the loan, like an origination or application fee. Third-party fees. This is the biggest chunk. It covers things like the appraisal to make sure the home is worth the price, title insurance to make sure the seller legally owns it, and attorney or escrow fees. Prepaid items, you have to pay some expenses in advance at closing. This includes your first full year of homeowner's insurance and a few months of property taxes. The fix is to be prepared from day one. When you first talk to a lender, ask for a detailed estimate of their closing costs. That loan estimate form we talked about breaks it all down. Compare these costs just as closely as you compare interest rates. And guess what? You can negotiate some of these. You can ask your lender about their fees, and you can also ask the seller to pay for some of your closing costs. It's a common negotiation tactic, especially in a buyer's market. The key is to know about these costs early, budget for them, and look for ways to reduce them. Section 9, mistake number 9, making major financial changes before closing. This mistake is an absolute deal killer. It can pull the rug out from under you just days before you're supposed to get your keys. Mistake number 9 is making any big financial changes between your offer being accepted and closing day. Your pre-approval is conditional. It's based on a snapshot of your finances at that exact moment. The lender will check everything again right before closing. They'll verify your job and pull your credit one last time. If anything significant has changed for the worse, they can delay or even deny your loan. You need to put your financial life on a complete freeze for 30 to 60 days. Here's what you absolutely cannot do. Do not quit or change jobs. Lenders need to see stability. Even a new job with a higher salary can cause massive delays. Do not buy a new car. This is the classic one. You're excited about the new garage, so you go finance a new car. That new loan can wreck your debt-to-income ratio and get your mortgage denied. Do not open new credit cards or co-sign for anyone. Any new line of credit can ding your credit score and mess up your ratios. Do not make large, weird cash deposits. Lenders have to source all your funds. If $10,000 in cash suddenly appears in your account, it creates a huge problem. Do not miss any bill payments. One late payment can drop your credit score and could even change the interest rate you were promised. The solution is simple, but it takes discipline. From the moment your offer is accepted until the keys are in your hand, nothing changes. Pay your bills on time, keep your spending normal. If you're getting a cash gift from family, talk to your loan officer first so you can document it correctly. Think of it as a financial quiet period. Don't touch anything. Just keep everything stable and boring until after you close. Section 10, mistake number 10, not planning for day one and beyond. You did it. You signed the mountain of paperwork and the keys are finally in your hand. It's an incredible moment, but the final mistake is assuming the spending is over. You've forgotten to plan for the immediate costs of day one and beyond. Having your savings account drained to zero by the down payment and closing costs is a recipe for instant stress. First, you have the moving costs themselves. Whether you're hiring pros or just renting a truck and buying pizza for your friends, it costs money. Second, there are immediate setup costs. You need to change the locks. You might have to pay deposits to get the lights and gas turned on. These small fees add up. Third, no matter how great the inspection was, there will be unexpected day one needs. Maybe the sellers took the fridge, maybe you find a leaky faucet, maybe you just need a lawnmower. These are the urgent things that require immediate cash. The solution is to create a post-closing budget. On top of your down payment and closing costs, you should have a separate cash reserve, an emergency fund for these move-in expenses. A buffer of even a few $1,000s can save you from having to put these first costs on a credit card. Before you move in, make a list of the absolute essentials you'll need in that first week. New locks, cleaning supplies, maybe some blinds for privacy. Price it out. By planning for these day after costs, you'll transition into home ownership with peace of mind, ready to actually enjoy your new home instead of stressing about how to pay for it. We've covered a ton of ground, from getting your finances ready before you even look, to the absolute importance of the home inspection. Let's recap the biggest takeaways. First, get fully pre-approved before you shop. Second, build a budget based on the true cost of owning a home. And third, never, ever skip the home inspection. It's your single best piece of protection. Buying your first home can feel overwhelming. It's complex, it's expensive, and there are traps everywhere. But it is not a process you need to fear. By understanding these common mistakes, you've armed yourself with the knowledge to avoid them. You've traded fear of the unknown for the power of preparation. You now have a clear strategic plan to move forward with confidence. You have what it takes to make the dream of home ownership your reality, the right way. What's the one thing that still worries you most about buying a house? Let me know in the comments below. I read every single one, and I want to help you get the answers you need. Thanks for watching, and congratulations on taking this huge step toward buying your first home.